Boy, what a bounce today. NASDAQ was up 3.69% or over 464 points. Is the market crash over? Or is this a dead cat bounce, aka bull's trap? On Monday, NASDAQ was officially in the correction state as it closed 11% below its February 12th peak. But it remains to be 7% below its all-time high. Could NASDAQ, a tech-heavy index, be on track for a V-shaped recovery? In this video, I will try to answer this as best as I can based on the indicators and why the market went up so much today. I will also discuss with you the psychology of the stock market cycle and if I think this is a dead cat bounce. So stick around. Swadee this is hello in Thai. My name is Anthony and welcome to Quantum Finance. If you're a returning viewer, thank you for your support and welcome back. If you're new, welcome. Please help us reach the 10K subscriber goal by hitting the subscribe button below if you have not already done so. Also be sure to like, share, and hit the alert bell button so that you can get my latest video. With that out of the way, let's get right into it. So why did NASDAQ stocks go up so much today? For one, this is because of the long-term interest rate. Let's take a look at this chart of the NASDAQ Composite Index compared to the 10-year Treasury note rate. Today's yield on the 10-year Treasury note dropped 1.54% after trading above the 1.6% on Monday. And of course, the stock went up massively today after its massive sell-off yesterday. Why? That's because the government had a bond auction today which helped drop the interest rate. I want you to see that there's a correlation that high interest rate yields will tend to pull money away from the high-priced stocks like high-tech, high-growth, and emerging economy stocks. Per CNBC, we can see that Chinese stocks are down by an average of 16%, while Brazil is down 12%, emerging markets are down by 10%, Korea and Philippines are down by 9%. Pretty much everything is near the 10% correction mark. This may explain to you why so many Chinese stocks, such as NIO, XPeng, Yihang, Alibaba, and JD, and pretty much all of them are down significantly as of late. You can see that when the interest rates are low, it is cheap to borrow money for companies to expand, and therefore the stock price tends to go up. So when the interest rate go up a lot and faster than investor had expected, like when it did on February 12, 2021, the stock market started to correct itself. Note that the only time there is no correction is during the March-April crash due to COVID-19. Both the stock price and the interest rate crashed. So the next question to ask is, will the interest rate continue to rise? And will the stock market continue to decline? This is where it gets tricky, and this is why I suspect today's market rebound could be a dead cat bounce. So what is a dead cat bounce? It is a temporary recovery in share price after a substantial fall caused by speculators buying in order to cover their positions. Another name for this is bull's trap. Investors buy into the rebound, but the market continues to decline the following days or week. This is what we have to be careful of. You see, many institutions and retail investors are using margins or borrow money with low interest rates. Why not? The interest rate is only between 2 to 3%. When the market goes down, however, investors who borrowed are in margin call and are forced to sell their positions. This is when investors start to panic because they are on borrowed money and they have to come up with money or sell their position to cover. They don't want to sell, but it's a forced sell. If they don't, the brokerage firm will do it for them, and if they do that, it may not be in the investor's favor. So you can imagine that the panic sell accelerates a market crash or correction. And on Monday, it was a major sell-off. So today, everything looks so attractive after a steep discount. So investors with money jump in and buy the dip. This, of course, creates a euphoria which spikes up the stock price, especially in the high-tech, high-growth, and emerging market stocks. Opportunist investors ask why not? The margin interest rate is still very cheap, and the FOMO or fear of missing out kicks in as they see stock price goes up and they buy into it. You get the idea. The market will accelerate in either direction. Just remember that when there's a massive sell-off, there is usually a massive recovery right after it. This is why I always state that it's very difficult to time the market as it happens so fast and so unpredictable. I'd like to share with you this Wall Street cheat sheet. The psychology of a market cycle. The past weeks, and especially yesterday, was a massive sell-off. I can safely say that everyone was in a depression and disbelief mode. So when today the market went up, everyone had a hope for a V-shaped recovery, that it is possible that this could turn around. So the question is, will this recovery happen or is this a dead cat bounce? We don't know. Anyway, as you can see from the chart, if this is truly a V-shaped recovery, then investors begin to have optimism that the recovery is real. Once they believe this, they start to invest more money into the market. Of course, the thrill of making lots of moolah creates euphoria, as they are a genius, you know? They can't go wrong because the market just go up north for them. And they forget that there's a market cycle and become complacent. The market repeats its cycle, it dips, and investors become anxious because now they're caught in the margin call again. They then go through a denial stage because they invested in blue chip or FANG stocks and it keeps going down in price. This should not happen, right? Their account is on a margin call and now they panic sell. The sell-off capitulated and they want 100% out in order to stop the bleeding. Once out, they may feel great for a while, but then they feel angry because they lost a lot of moolahs and then they go into a depression mode until a day like today happens and then they're in disbelief of what just happened. My God, the stock market's up again. I just lost lots of moolah. Why? Welcome to the stock market, guys. Anyway, moving along, let's take a look at the NASDAQ chart. As you can see from its low point in March 2020, it has been in a very bullish uptrend. When it dipped, it bounced off the trend line. However, as of late, NASDAQ is now below the trend line and the 50 EMA or the 50-day exponential moving average. I believe it will retest the 50 EMA line, and if it fails to break above it, it could come down again. So this is why it could be a bull's trap. Bear in mind that the government did have a bond auction today, which caused the 10-year yield interest rate to drop today, and they will continue to hold more auctions tomorrow, so this is all positive. Okay, so now let's look at the S&P 500 chart. It was up 54 points or 1.42% today. It did recently bounce off the trend line and the 50 EMA, so the S&P is in a much better shape than the NASDAQ. Now, the Dow Jones Industrial Average was up 30 points or 0.01% today. It has been up for the past 3 days. It did a similar thing as the NASDAQ index, but it is in much better shape as it is above the trend line and the 50 EMA. Okay, so you may have noticed that when an interest rate increase, this is a positive thing for the financial sector. In general, these stocks benefit from the rise in bond yield. So today, most financial stocks are lagging because of the interest drop. This is because banks tend to do well when interest rates are rising because they can make more money by charging higher interest rates on loans. Bank of America, for instance, fell about 2.18%, while American Express slid about 3.44% today. Right now, the major concern is that when yields have been climbing with rising expectation for growth, the fear is that inflation could follow. Higher yields does put down pressure on stocks generally, in part because they can steer away dollars that might have gone into the stock market into bonds instead. That makes investors less willing to pay for such high prices for stocks, especially those that looks the most expensive in the tech, high growth, and emerging market stocks. Having a correction to the NASDAQ is important because many investors and traders who use technical indicators will decide when to buy or sell their stocks. You probably heard it many times that a correction is typically seen as a healthy moment for the stock market, giving investors a chance to pause and reallocate their investment without the volatility. Hopefully, this video is of value to you to understand why the stock market rebounded today. My concern is that we're not 100% out of the woods yet. I would be cautious for the next few days to see if the market will continue to rise like it has today. Or is this a dead cat bounce? A trap for the bulls? Should that be the case, we could see more bloodsheds ahead. Let's hope that's not the case. I am optimistic, however, that today's market rise could be a start of a rebound. But then again, anything can happen in the stock market, guys. Best of luck. If you find the video of value, please like, share, and hit the subscribe button if you haven't already done so. Thank you, and let's go make some mullahs!